Welcome back to the Stock Indicator Simplified Series. Today we are looking at MA50 and MA200 crosses. MA means moving average. A moving average smooths price by averaging recent closing prices. Instead of reacting to every little daily wiggle, it draws a cleaner trend line through the chart. The 50-day moving average uses about 50 trading days. It reacts faster, so traders often use it for medium-term trend changes. The 200-day moving average uses about 200 trading days. It moves more slowly, so traders often use it for bigger, longer-term trend context. The alert idea is simple. If price crosses above the moving average, it can suggest buyers are pushing price back above an important trend line. If price crosses below the moving average, it can warn that sellers are pulling price under that trend line. For example, a stock crossing above its 50-day average may be recovering after a pullback. That does not automatically mean buy, but it can be a useful signal to review strength, volume, and the nearby resistance area. A stock crossing below its 200-day average can feel more serious because many traders watch that line as a long-term health check. Again, it is not an automatic sell signal. Sometimes price dips below the 200-day average and quickly recovers. The common mistake is treating every cross like a clean trend change. In a sideways market, price can cross above and below a moving average many times. That is called whipsaw, and it can create noisy alerts. So use moving average crosses as a filter, not a full trading plan. Check the broader trend, volume, support, and resistance, and your risk before acting. In signal alert, add MA50 cross or MA200 cross. Choose whether you want cross above or cross below and create the alert for the stocks you care about. The goal is simple. Let Signal Alert catch important trendline crosses so you can decide whether the setup deserves a closer look. Visit Signal Alert, EO, and build your next market alert in minutes.